It is very actionable. That was one important thing. So I thought I'll ask him to come to speak to our forum also. He's the vice president and head of research in Funds India, which is a 10,000 crore AUM company, which is one of India's largest digital private wealth management companies. He's previously worked with IIFL Finance Wealth and Wealth Advisors. Uh, his actually score is more into portfolio construction, asset allocation strategies. It's about behavioral finance. That is his expertise areas. Uh, Today, he speaks in many forums like Live Mint and other areas in the media also. So I think his presentation today will be useful to all of us. We look forward to hearing Mr. Arun Kumar speak. Thank you.
Now invite Mr. R. Arun Kumar, Vice President and the Head Research of Consumer to address the meeting.
Okay. Thank you so much for, for me, this is probably the first time that I'm doing something at as early as 8:30 in the morning. So I was really surprised to see so many people. So I really hope I'm able to add some value to all of you. And most importantly, if you broadly look at whatever we find in Twitter or all the social media, mostly it's related to how to pick stocks. But if you look at the irony, almost 99% of us can't pick stocks, and mostly we end up outsourcing it to, say, fund managers or some strategies. But there's very little insights around how to select a good fund manager. How do you put them together? How does it work? What are the problems there? What should you look out for? So in essence, the next half an hour probably I'll touch upon what we do at Funds India in terms of how we address these problems, and this has some theoretical backdrop, but most of what we do, almost everything that I'm going to show in the presentation, what we've practically been doing for at least for the last 3.5 4 years. So mostly the results that you're seeing are not like some backdated, some tested things. These are real life things. So I'll probably share some learnings that we had, some mistakes that we did, but broadly the essence is hopefully I'll end up adding some core concepts and some core learnings to it. So I'll start off with yeah. So net, if you look at any every time that either we get pitched by pitched a particular equity fund, or it can be anything, equity fund, equity PMS, equity AAF, by or you are yourself doing a research, the fundamental first question that you'll ask is, what is the last 3 year performance? What is the last 5 year performance? So essentially, I've been in the industry for almost from 2011, and then I used to work a lot on figuring out mutual funds, putting it together. But inevitably, every time we used to come up with a list. After 3 years, I found that most of those funds were not doing well. Again, we'll do some metrics and all that, and again the next list will seem to have good past 3 year performance. Again, so almost for the first 6 7 years, I was also confused, like what is happening and all that. But now I kind of have some sense of what is really happening, and that's what I want to show. But this is the actual data. So what we did was very simple. We said let's take all the diversified mutual funds, which means that they don't have any sectoral difference, all mid cap, large cap, small cap, flexi cap, all put together. So that's mostly all the funds that you will get in terms of for you to select. Usually, what you will do, you look at the last 3 year performance and then say which are the number one, number two, number three, number four, and then pick on it, right? Now the key question is that the last 3 year performance is already done. So the one single question that you need to ask additionally is that, hey, this you've shown me 5 funds which have done extremely well for the last 3 years, but actually I should have gone back 3 years and then invested, right? What was the fund's return at that point in time? So we just asked that question and we put it together in terms of this format. So we said in 2020 to 22, these 3 years, the number one fund, number two, number three, we took the 30 funds. And we then asked the simple question, 3 years back, what was the ranking of these? So here comes the irony. The number one fund of today was ranked 113. So which means that if you look at the number one fund today and say you're going to invest, you should have actually invested 3 years back. And 3 years back, when I came to you, the fund's ranking was 113. Now, what would you have told me? Hey, Arun, there are 112 funds which are doing better. Why in the world would you want me to do the 130? Now, look at this. This is the same pattern across. This is for the current 6 years. Before that, also the same thing. So you can find that the same pattern is repeating again and again and again and again. So this is the first counterintuitive thing. Because if you look at every other field in life, you go to a restaurant, the past ratings work. You go to a movie, past ratings work. You're hiring a person from IIT, IIM, and he's done over 10 years, he's done well. Mostly he or she will continue to do it. So mostly going by past is a thumb rule which works really well in most areas of life. But unfortunately, in especially fund selection, it backfires big time. And we reverse the question also. So what happened to the 1, 2, 3, 4, 5, 6 top 30 funds 3 years back, which is exactly the number of these are the top 10 funds that you would have probably ended up buying 3 years back. Now look at their ranking 165, 161, 53. So you can see how this pattern changes, right? And then again we flipped it, the same question we asked, and on average you split it into quartiles, like the top 25%, the second 25, third 20. So we just asked the question, if currently if a fund is forming in the top quartile, most likely will they continue to be in the top quartile next 3 years? Because that's all that matters to us, right? Because the last 3 years is already done. And we found that only 1 out of 4 funds that is there in the top quartile continues to be in the top quartile. And same thing, when we did it for 5 years, only 1 out of 5 funds actually stay in the top. So the first important, irrespective of if you forget everything, it's fine. But the biggest challenge that if any one of you is trying to pick PMS, AAF, mutual funds, any fund manager, if you're trying to select, the last 3 year or last 5 year returns, if you only go by that, and if you get the comfort that it is doing really well, most likely you'll be disappointed. This is pure data. I mean, like whether you run it or I run it, this doesn't change. So the first challenge for all of us who is trying to build a portfolio is that if I only go by past performance, then most likely I'll end up with that 160, all that bad performing funds over the next 3 years. So this is the first challenge. So the second challenge, no, this is a little heavy chart, so don't get worried. It's just that we put together all the funds, all possible funds which are there in all cap. Basically means they are free to move between large, mid, flex. So which means the fund. And then we said so for example, this is Aditya Birla Dividend Yield Fund. In 2006, what was the outperformance vis-a-vis the benchmark? 2007, what was the 3-year outperformance? So every year we said what is the outperformance. Now you can look at green means it's outperformed, red means it's underperformed. Is there a single place where you see only greens? So which means irrespective of any fund that you pick, be it a great fund, bad fund, good fund, all funds go through temporary underperformance. Now the point with bad funds is that the underperformance is very stark and the outperformance doesn't compensate for that. But even if you pick the best fund managers possible, you will have to deal with the rates. Now this is for one set of it. There's a long list, so you can see that don't worry about the numbers, but broadly the takeaway is that the rates are inevitable. So which means that again this is for an ELSS category, which is again it's a tax saver category where the fund managers are free to move between large, mid, and small. Again you will see the same trend. So what is being green for some time again becomes red, and again becomes green. Same pattern happens for mid caps. So and you can see that the biggest investor of all times, Warren Buffett, even he has had several periods where he has underperformed drastically. So first challenge is what? I can't go by past performance. What is my second challenge? Even the best of the best guys will go through underperformance. Now the challenge here is that, So when every fund goes through underperformance, so which means a bad fund will also go through underperformance, a good fund will also go through underperform. Now the challenge is what? Every time the underperformance comes, how do you differentiate whether it is a bad fund going through underperformance or a really good fund manager who is temporarily going through underperformance? Because net for you, you have seen the last 3 year returns, index is say at 15, you are at 10, you're saying anyway it is underperformance. So how do you know if it is good or a bad fund going through? Because if it's a bad fund, then you get stuck. Because a bad fund genuinely has to go through underperformance at some point in time, and most likely it won't recover. So the second challenge is underperformance is a given. So which means irrespective of any fund that you pick, good fund, bad fund, you will obviously have to go through 2-3 year periods where it will underperform. And then how do you know whether it is good or bad underperformance? Because then otherwise you will become complacent. If you say all underperformance is good anyway, over the long run it will go. What if you get stuck? So which means this is again counterintuitive, right? So this is the second challenge. Then the third challenge is there's an interesting Sherlock Holmes story, right? Where see basically what happens is that there's an accident scene, and where so basically Gregory is his friend, and he asks him, hey, is there any information that we need to know? So Sherlock says that there's this dog which you guys didn't notice. So the guy says, hey, the dog basically didn't do anything. So what should you do? That's the whole point. The dog did not bark, which essentially means the person who has committed the crime is known to the dog. So the whole idea is that sometimes you ask what is not there, which was supposed to be there, and then from there you find the clue. So just extrapolating this, you most of us look at value research, Morningstar for ratings, right? Now, think about it. If these guys are running ratings for the last 20, 30 years, is there one single ad where they say, hey, this is my last 20-year rating process. My 5-star funds have given X percentage over the benchmark. Is there a single ad which shows the ratings actually work? But they've been doing it for 20 years. Now, logically, they do all sorts of marketing. If the ratings really worked, who was the guy who would have gone left, right, center and advertised? It is the rating agency. But have you ever wondered why they have not advertised it? Not a single ad till today. Morningstar is a 30-year-old company. So which is why sometimes you have to notice what is not there. The fact that there's not a single ad shows us something. So there was this Wall Street article which studied Morningstar ratings. Then they basically found that out of all the 5-star funds, only 12% actually continued to be 5-star. And on average, over the next 10 years, 5-star became 3-star, 4-star became 2.8, and 3 stars became 2.5. And Morningstar themselves finally had to retort, and then they said, this only possesses very moderate predictive power. So use this only as your first step. So they themselves said, hey, it is not supposed to be the final selection parameter. Just use it as one basic starting point. So which means the third problem for us is that the ratings are also more or less, there is hardly any use from the ratings. So let's put all the, so if you forget everything from the presentation, just make sure that at least we understand these three challenges properly. So which is, if you are only going by past 3-year, 5-year performance, most likely you will be disappointed, because that's what historical data shows. Second is, irrespective of whichever fund you pick, your fund 100% at some point in time over the next 10 years will go through 3-year, 5-year stretches of underperformance. And the third is, ratings don't help you. So if you go by ratings only 5-star funds, that also doesn't work. So now we have a problem. Now these are the three counterintuitive challenges. How do we solve it, right? So the second question is, before we solve it, let's also understand why this happens, because we have to understand it's very counterintuitive, right? It's not happening anywhere else in any other field. Why is it only happening in investing? Because of a very simple thing called a cyclicality. So in investment, there are different approaches which fund managers follow. Certain fund managers will have a quality oriented approach, which means they'll only pick companies. So think about it like buying an Apple phone. An Apple phone is extremely expensive. At the same time, a lot of us can probably buy a OnePlus or an MI. But Apple, you don't mind paying a price because of its quality. So these quality fund managers have the same approach, that I don't mind paying slightly higher valuations for high quality stocks, but I will pick only higher quality names. And then similarly, you have another style called low volatility. Basically, they buy only stocks which have very, very low volatility. And then there is a global There's a dividend yield strategy which buys stocks which have very high dividend yield. And then there's a value oriented strategy which buys lower value companies. So there are different styles. So the fundamental thing is that no style is always there in the top. So value did really bad for 18, 19, 20. So if you look at any fund manager who was following the value style, say somebody like Prashant Jain or ICICI Prudential, Shankar and Nare, most of them had a very bad time. But then in the last 2 years, they've done disproportionately well. So the key point is that so it's like if you're a fast bowler, you can't say, hey, suddenly the pitch is great, so I will start doing leg spin, or suddenly I'll make it, I'll become an off spinner, right? You have practiced your entire life to become a fast bowler. So irrespective of the pitch, you do fast bowling. Eventually, over 10 matches, probably 3 matches won't be in your favor, but the remaining 7 you will get it through, right? So similarly, all these fund managers are aligned to a particular approach. So suddenly you can't make a value guy into a quality guy because both require completely different mindset. It's like asking the fast bowler suddenly to do off spin. The key point here is that all these styles don't stay in the top always. So they will come down, they'll go up. So there's no pattern to the madness. So which means all fund managers who are following a particular style will eventually have to go through these bad times and good times. Same thing happens for mid and small cap. So you will find that the yellow line is the small cap, the red is the mid cap, and the blue is the large cap. You can see eventually over a cycle they all converge. But if you measure performance at this level, everybody will say hey, small caps are the best thing in the world. Everybody has to invest only in small caps. And then by the time this thing comes, then they'll be like, no, why do you put small caps? Small caps have a very, very bad experience. I'll only put in large cap. Again, the cycle changes. So depending on where you are measuring, so right now everybody wants small cap because you haven't seen this die. Let's say you go back to 2020. From 2018, small cap funds were almost down 50%. So nobody wanted to touch small caps. But right now, everybody only wants small caps because again, look at where you are measuring. So the key point is that just like how you had, so just like how you had cycles in the individual styles, you also have a large cap, mid cap, small cap cycle. This again the same thing. Again within sectors also the same thing happens. Like one sector which is on top suddenly say you take any sector, say FMCG, it was on top, then it comes to the bottom, and suddenly it's at bottom. So all sectors go through periods where they do really well and they do extremely bad. So net, and then again country wise also you find the same split. So broadly the idea is that unless and until a fund manager can do all of this, I pick the right country, I pick the right sector, I pick the right style, and I keep changing it every year, it's almost impossible to be on top. But no fund manager can do it. So mostly they will stick to one style, and the style will do well over probably 7 years, provided they have executed the style well. So which means inevitably when the style goes through a bad time or the sector goes through a bad time, or let's say the large cap, mid cap, small cap split also will be different for different fund managers. Based on which part of the cycle you are measuring them, you will find that gets translated into. So this is why this happens. Okay. Now, finally, for us, the key question is what do we do and how do we build portfolio? So we have 3 challenges. Now we found out why this happens, and most importantly, what is the solution? Now, globally, the most popular solution, which is getting a lot of noise, is what is called passive funds, which is essentially very simple. Boss, all this is too complicated. I have no idea what to do. Let me keep this really simple. I am going to buy all stocks. If there are 500 stocks, I will buy 500 stocks, give them the same weightage. But the basic idea is I don't want to pay the fund manager any fees. I'll cut down the fees, and hence because it's automatic, right? It's just rule based. So let's assume that all of you are SME business owners. Let's assume I put all your business values and then I arrange them from the highest to lowest. And then I say somebody business who's worth say 1,000 crore, I'll put the highest exposure. Somebody's business who's worth 100 crores, I'll give lower exposure. Now, obviously, you will retort saying, why would you think 100 crore business can't do better than 1,000 crore business? That's a logical retort, right? But this is a formula. So passive investing essentially means the larger the better, or the bigger the better. Okay, and this is all automated, so you have very, very low cost. And globally, because more and more institutional players are coming onto the equity markets, it's very, very difficult to find informational arbitrage. More or less, everybody is intelligent, and almost all the details regarding the top 100 or 500 stocks get captured in the prices, and thereby it's becoming very difficult for normal fund managers to outperform the passive indices, especially on developed countries like US. Look at the evidence, you can see it, right? This basically shows in 5 years what percentage of funds underperform the passive benchmark. So 91% in Europe underperform, 87 in US underperform. So you can see different in India, 94% of large cap funds underperform. Right? So this is a global trend that's happening. So which is basically you say that I don't want to apply my brain. I just buy the top 100 stocks, top 200, top 300 stocks, and then let it run. Right now in India, you can see how this is the 3-year outperformance of large caps. So till 2018, most funds were able to outperform comfortably. But post that, you can see a sea of red there, which means that a lot of funds are struggling. Two things happen. SEBI came up with a rule saying that you have to compulsorily keep 80% in the top 100. Earlier there was no rule, so a lot of people had higher exposure to mid and small cap because it was still not defined. But post this, it became very difficult. Now at 2020, we took a call that large cap funds will start to outperform because two things were happening. One, they had 20% mid caps. Mid caps were doing bad, so we thought mid caps will do well, and hence there is a performance kicker that will happen. The second thing is that the top 10 stocks were doing disproportionately well, and usually these things mean revert, right? And then the remaining 40 stocks or the remaining 90 stocks will also do well was our call, and the call came exactly right. The mid cap started to do well, and the top 10 stocks, the performance started to distribute across, but still the large caps were underperforming. So we also got confused. In fact, we wrote it first in 20, and again we wrote in 21 saying, hey, the call has come out right, so most likely it should play out in large caps. But then last year again, when we looked at it, the funds were still underperforming. So we got confused. So then we realized that there's a third dimension which probably we did not notice in the first level, which is the fact called so there's something called active share. So it's a technical term. Basically, it means how much of your portfolio is actually different from your original the index. And if you look at it, the actual portfolio which is very different from the index is very low. So which means only 30% or on average only 40% of the portfolio is actually different from the index. So every time you buy any large cap fund, 60% is the same. So with 40%, I will have to outperform the index because the other 60 is going to be the same. So when we roughly work the math out, it meant that for taking a performance of 1% over the index, you roughly had to do 6% every year on that 40% differentiated portfolio. So if you don't outperform by 6% on that 40% differentiated portfolio, you can't at an aggregate level, at a portfolio level, you can't do a 1% outperformance. So which means that the barrier to outperform became so high that eventually Indian large cap funds are getting into a trap. So how can they come out of it? One, they start increasing the active share or they start reducing the cost. So we'll have to wait. Few funds are taking like DSP has started to increase the active share, which is the differentiated portfolio. But otherwise, most of them are still stuck in the 40% band. So broadly, our view is that if you are somebody who only wants large caps, then I think you're going for a Nifty 50, Nifty 100 index is more than enough for you. Okay. So that's the first broad thing. We got the call wrong, but obviously after doing this, we have again changed the call. So we've almost written 3 blogs on that. So maybe if somebody is interested, you can exactly look at what we were thinking, how we went wrong. This is there in our public blog at Funds India. So the last point is that very simple. The key point to remember is that then sometimes we become so maniacal about this that we forget to use our brain. Net it says that larger is better. So if larger stocks do well, this is favorable for passive. And fortunately, the last 10 years has been in US in such a way that the top 10 stocks, the FANG stocks, the Facebooks, Amazon, the larger has done extremely well. So the environment has been favorable. So this is something that we shouldn't forget. And the active versus passive, which is the fund managers vis-a-vis the passive, is also cyclical. So US has gone through a long trend. So at some point in time, it might revert. And this is the percentage of fund managers who outperform. So you can see that it's again a cyclical trend. So you shouldn't think that active has something magical to it, that just using the single formula will always work. But it's a very simple thing. So if you don't want to do any analysis, nothing, then probably this is a good starting point. But you also have to know that at some point then this will also revert, just like what happened historically, and active funds will continue, may start doing well, especially in the global markets. But the key point is that behaviorally passive guys have figured out a nice way to address this. Every time a good fund manager outperforms passive, they go and say, "Hey, there is no way I could have identified this before. Like it's happened, but there's no way I could have identified." So thereby they come to a nice regret minimization framework. So net passive works well for them because once they get enamored to this, they start putting a lot of tweets, social media, and then this becomes more like a religion. Every time somebody outperforms, then they say, "Hey, no way I could have figured you out 3 years back." So net behaviorally, they've figured out how to address the distortion that happens. So overall, this is one strategy that is a good starting point. We don't, we use it only for large cap oriented clients, but we ask the question that, hey, this is one formula, but can there be better formulas which probably beat the larger the better? So that's where we found that there are these 7 formulas or approaches to picking stocks which has worked across the globe and not just in a particular time frame, over a long period of time, right? So one is quality, which essentially means you buy companies which have very high ROEs, ROCs, which have very low stress on balance sheets. They have a very good product. The growth numbers are strong. Then value contrarian is like basically you buy beaten down companies which are currently going through problem but are probably good stocks, or which are very let's say PSU stocks where in the value bucket, say 2 years back. Then growth at reasonable price is more like an Indian style where you say, I neither want to be too quality, I neither want to be too value. I'll go somewhere in between. So think about quality as an iPhone, value contrarian probably as an MI phone, and growth at reasonable price maybe like a OnePlus. Mid and small cap is a new all the smaller sized companies. Momentum is basically you buy, you don't care about quality anything. Any stock which has done well in this last 6 months, I'll buy. And low volatility is stocks which are very very low volatile in nature, and then dividend is stocks which pay high dividend. Now dividend unfortunately in India has not worked, so this we can eliminate. So that means we are left with 6, but low volatility and quality always have a very high overlap, so we can eliminate low volatility. Momentum actually works the best across the world, but unfortunately the churn is very high, and hence it is still very very difficult to capture the momentum returns, and it's very difficult for mutual funds because once they grow in size it becomes difficult to execute. So which means we're left with 4 different investment styles which are proven to outperform the passive benchmarks over 7-year 10-year cycles across the world. So the question that we asked was, what if we figure out one fund each for this style and then put them together? Because then what will happen? At some point in time quality won't do well, but I will have value which is compensating for me. At some point in time, growth might not do well, but I'll have something else. So the idea was figure out 4 or 5 styles which do better than passive, but all these 4 or 5 are very different, and then put them together and then check how does it work over long periods of time, right? So this is the proof in terms of, so globally almost for 95 years, this all the mid cap strategy has worked better than large cap. The value style has worked better than growth, and then quality stocks have done better. So these are proofs which are available. I'll just skip it. This is the Indian proof. So when we check for all these styles, we found that except for value, on average 90 to 80 to 90% of the times on a 5-year basis, all these styles were able to outperform the Nifty 50, which is the passive index, which is exactly what we wanted. So what did we want? The first option was directly go to Nifty 50 or Nifty 500. The second option basically we wanted was how do we outperform them. So we said over a 5-year cycle, where are my odds the highest? So quality 93% odds, momentum 99%, low volatility 93%, and then mid cap is 83%. Value, this index is not capturing it well, but there are a lot of value fund managers who have comfortably outperformed. So for value, we will have to give a slight exception. Same thing, we asked the question, what is the percentage of times they did more than 12% returns? Again, we got a similar number that almost close to 60 to 80% of the times, all these styles have done really well. So the overall idea was very simple. So the proof is there globally and in India that these styles work. So then we said to ourselves that let's put these styles together, where value is one style, quality is one style, mid cap is one style, small cap might be a little risky, so you can keep it to your tactical portion, and then growth is one style, and then you take one fund from the global side. So overall, the beauty of this construct will be that you will get 5 different funds And then the global, you can take a passive exposure, which means only you need to pick 4 fund managers. But all these 4 fund managers are using very, very different investment styles. So what we did was we picked 3 funds or 3 to 5 funds under each bucket, and we said let's mix them together. So this is something that we've been running from 2020 beginning. So let's look at what really happened after we started running. So the first key point is that the idea of mixing them together is that they should not be similar to each other. So that thing gets satisfied here, because if you look at it, quality and value, there's only 7% overlap. So you can see the overlaps between the funds are very, very low. So one, I've figured out styles which work. Two, I've put them together in a way that there is hardly any overlap. So which means all 5 funds are extremely different to each other. And this is how they work. And they shouldn't work at the same time. So the day quality works, next few years quality didn't work. Then again quality work, quality didn't work. Look at value. Value is working last 2 years, previous 4 years it didn't work. So the broad idea is that while these guys work over long periods of time, in the short run they might not work. But every time value doesn't work, something else compensates for me. So the idea of mixing them together is that at the end portfolio level, if I am the client, will I get a far more smoother experience? And I don't individually need to worry saying is quality going through underperformance, is value going through underperformance. And every time some fund is going through underperformance, I can check the other funds in value. If all the funds are underperforming, then there is no problem. Then it means that it's only the styles problem and not the fund manager's problem. And if it's any one fund manager is goofing up, the other value funds won't show the deterioration, right? So you can catch the fact that is it a good underperformance or bad underperformance. So this will make it. I mean, we do a lot more analysis, but I'm just saying as a crude way, this will make life a lot more easier for you. So this is also working well. So now the key question for us was when we put it together, does it work? So this was obviously till 20, it was back tested because that is when we started this. So we saw this amazing numbers and then we said, let's try it out. So overall, this is obviously, so 20 is back tested. From there on, it's the real life portfolio. And we've hardly changed anything. The same 5 funds that we put on 20, we did nothing. It just continued to perform. And overall, you can see that over a long period of time, it gives significant outperformance vis-a-vis the passive benchmark. Then this is how the performance for 10 years looked like, 19% vis-a-vis 15 or 16 for the index. It is almost a 4-5% outperformance. This is probably back tested with the last 3 years alone, but this is the actual one. So we made almost 20% returns over from Jan 20. Jan 20 was the previous peak of market, so it was almost at 40,000 levels. And you can see how Nifty 50 had done only 16 or 18. So overall, the outperformance was close to 5% and 3%. So which was the broad intent that over a long, I mean, 3.5 is still a short cycle. Probably over 5-7 years we'll get a better picture. But right now the plan seems to be working perfectly as expected. Right? And this is so it shows that almost 99% of the times you have outperformed on a 5-year basis, and 70% of the time the outperformance margin was almost more than 3%. So which means that the framework or putting these styles together seems to work really well over 5-year time frames. And this is how the performance has matched on all 5-year basis. So you can see this is the 5-year number. You can see how consistently it is outperformed. And this is the real life thing. So you can see how it's consistently done well. And then we asked what is the minimum return that you get. At the historically it was 4% vis-a-vis -1 for Nifty 50. And 90% of the time you also ended up making more than 12%. So broadly, the idea of putting it together seemed to work well from a performance point of view. And this is the calendar year return. So you can see mostly it has been able to outperform the index. Right? So now the question was, okay, so it is performing well. What is the kind of risks that we need to take to get there? So here you can look at, so this is a little complicated chart. Blue line shows the drawdowns. And whenever blue is lesser, it means it's fallen lower. So you can see mostly the blue lines are lower. And this is the periods where there was a large fall. You can see every time the approach of combining these styles together, the 5-finger approach, has been able to reduce your downside as well. So you're getting lower volatility than Nifty 50. At the same time, you're able to outperform. You can see each and every year, there's an intra-year volatility, that every year there will be a small fall. And you can see how in each and every year, this fall is also reduced by a significant margin. And this is, okay, this is a little... So overall, the broad idea was that if you figure out, now these are four styles that we identified, but if you are constructing the portfolio, you need to identify styles which you think make sense and put them together, because otherwise at a portfolio level it becomes very difficult to hold on when funds underperform. Now behaviorally what we have seen is that when we launched the portfolio, value style was doing really bad, so all clients were that except for value can we have the other four. But as luck would have it, at that point in time, quality funds were very doing well. So everybody wanted only Axis funds. But then the next 3 years, Axis did insanely bad. And as luck would have it, we had iPro value discovery as our thing. iPro actually ended up saving the entire portfolio. If we did not have iPro value discovery, we would have got killed by our clients. So what clients really hated, and then everybody wanted Nasdaq. And then 2022, everybody was sad that Nasdaq didn't do well. Then suddenly last year it again came back. So what we have realized is that mixing and matching the styles together also improves the staying power. So for the first time in almost like 12, 13 years of my career, I've been able to convince clients to stick to underperforming funds, because at an aggregate level, we have still been able to comfortably outperform. So we are able to tell the narrative that, hey, value was not doing well. Now it's doing well. Quality in the last 6 months has started to pick up. So now it's very difficult to tell when it will turn. But the idea is that once you put it together, you don't need to worry about it. Over a 5-year cycle, it will come up in some year, but overall over a 5-7 year cycle, you'll get a very smooth experience. So that's the second, and this is something that we follow at Funds India, and it's kind of worked really well, both from a performance point of view, reduces the declines, and the third point is behaviorally, it's made it a lot more easier for our clients and for us also, because and there is very low activity. We have hardly changed the funds, just the 5 funds. We haven't done anything. One rebalancing call was taken when the global portion became less than 15%. So all we do is we take 5 funds, split it 20% each. So if you have 100 rupees, quality is 20, value is 20, growth at reasonable price is 20, mid cap is 20, global is 20. That's it. And if something does well or something doesn't do well, and then the band goes below 15 or above 20, we just bring it back to 20. That's all. And we've hardly done anything. Last 3.5 years, we've just made one move, and the funds remain the same. We have not changed anyone, despite the fact that 2 funds are underperforming and probably in the bottommost at this juncture. Still, at an aggregate level, we've done well. So the point is, at some point in time, those two will pick up. This is something I'll just skip it. So broadly summing it up, the three challenges are that don't go by past performance, misleading. Temporary underperformance will always happen. And the third is the ratings don't predict future performance. So you need to understand that performance is cyclical. The way to approach this is either you take a passive approach, but if you want to beat passive, then you will have to take a style-based approach. Now, the styles that we preferred is what I've discussed with you, but there are other styles also which you can look out for. And we also use a tactical strategy where we go for good fund managers who are underperforming badly, and then we try to take tactical calls. First, we did IDFC Sterling, worked really well. Then we did iPro Value Discovery, worked well. HDFC Flexi we did. Right now we're taking a Franklin Time. I mean, it's not a fun suggestion, but just that this is also, but this is it's again probably a 1 hour presentation at some other time in the future. But this is probably the third level where, so the way we approach fund selection is out of 100 rupees in equity, 80 rupees we put it into our core 5-finger strategy. The remaining 20 we take high risk bets through consciously going for underperforming funds. Because when it picks up, it picks up drastically. One example is this. HDFC was underperforming in 17, 18, 19, 20. We took it around 21 end. You can see suddenly how it started to pick up. The moment 21 performance picked up, it pulled up 3-year, 5-year, 7-year. But to actually enter in 21, when we did the note, we were underperforming. The fund was underperforming in 1 year, 3-year, 5-year, 7-year. So we found it very difficult, but yeah. And then again, value discovery, same thing happened till 2019. If you look at it, 1 year underperformance, 3-year underperformance, 5-year underperformance. But look at what happened after 20. It just fired. So this is a fund which actually rescued us. So, but we actually entered here. So which is why all clients were disappointed, because hey, around 16 it's underperformed, 17 it's underperformed, 18 it's underperformed, 19. Why in the world do you want this one? Except for this, can we have everything? but because that we were able to put it in a structure, we were able to get the buy-in from our clients. So I think this is again one more thing where you can use to build your tactical push. So overall, the idea is that make sure you are diversified across different investment styles, and within that, try to pick fund managers. Don't start randomly picking fund managers based on only the past returns. So yeah, so that's broadly what I probably want to communicate for today. Thank you. I hope I.
Thank you so much. Can we have the dignitaries on the dais please again? Very important.